So if you have friends and family, which is your Uncle Joe and stuff like that, the one danger is you got to be very careful, excuse me, about taking money from unaccredited investors. Generally, if you take money from unaccredited investors and it's under $1 million, it's a 504 exemption. You can get
What do you mean by unaccredited investors?
Well, accredited investors are defined by the Securities and Exchange Commission as people with $1 million or more of net worth, not including the home. It used to include the home, and about a year ago, the SEC changed its mind on that and said the home was now out of that picture because of what happened with the whole housing market, and people had inflated homes and had a net worth and really weren't accredited. So they took the homes out of that. So it has to be $1 million in net worth, not including the home, or $200,000 a year. Daniel's at 200. I think it's $200,000 a year of income for the past 2 years, and an expectation in the present year you'll make 200,000 or more. So there's a series of tests for an individual. There's a series of tests for institutional investors and all as to what qualifies as an accredited investor. And if you're going to take money from someone, you absolutely want to talk to a financial lawyer who will assess for you whether or not people are accredited or not. If they are accredited, there's a lot less disclosure you have to give them. If they're unaccredited, you generally want to do what's called a PPM, a private placement memorandum, which explains all the risk factors and the fact that you could lose all your money. It's dangerous to take money from an unaccredited investor with just a simple subscription agreement or a simple stock purchase agreement, which more sophisticated angels and venture capitalists are held to a higher standard because they are accredited, and the court system and the SEC figures those accredited investors are intelligent enough and savvy enough to do enough due diligence to make an informed decision. They want to protect little old ladies from giving their life savings to unscrupulous mobile developers, So not that there's any in this audience, but it's the other thing that happens if you take unaccredited investors and then you have a VC that comes along and is licking his chops about giving you, a couple $1 million. If you've taken the unaccredited money within the last year, first of all, they don't like unaccredited at any point in time, and because they just don't want to have to get their votes on issues and deal with too many shareholders. But the other problem is if it's within a year, the SEC treats any financings within a 12-month period as being part of the same financing. So it's a real problem for VCs to be lumped together with unaccredited investors. So it can be, it generally is, unless you have to, you try to avoid taking money from unaccredited.
There's a waiver if you're a co-founder and you're putting your own money.
Yes. Yeah, if you're a founder and you're starting your own business, or a bunch of founders come together, if the Yermo and Sanjay and I get together, Yermo's the only one that's accredited. Well, you're the only one that would be accredited between the three of us, of course. But
crowdfunding, how does that affect
what's that?
this model? Crowdfunding.
Yeah.
Pledges.
Good question.
Crowdfunding?
The angels
Crowdfunding.
and all
Yeah.
that.
Kickstarter. How does that affect?
If they're not accredited, that'd be an issue.
That's not, I don't think it's credited. But
Yeah, no, that isn't. I think it's fair to say that you're talking about those angel sites out there where folks will go put their business plan out and go seek funding. That is a new and fascinating area of securities and exchange law,
it's like
Is that a euphemism for expensive?
Or dangerous.
or dangerous.
okay.
I would stay away from uncharted territory until you see other people either go to jail or not. So next.
Kickstarter is a little different in that people pledge capital and there's no equity exchange. There's a pledge, and I'll give you some really cool T-shirts, or you'll get your name on the software credits or something like that.
Yeah, so there are sites like that. I know, like there's Sweat Equity Connection out there, and there's other sites where
There's no equity involved in Kickstarter.
Yeah, and so
It's a big source of funding for companies.
Yeah, and so it's what we're talking about here is to the extent that you are transferring equity interest in the company. That's where these rules really kick in, and where these considerations come in. Where you're talking about somebody not taking an equity interest, yeah, there's a lot of permutations you can do in those types.
Yeah,
of
but the
scenarios.
IRS also likes to tax bartering. So, if on an audit they find out that you did give away equity for services and things like that, it's considered to be income to the company and to the one who received the stock. And then there's a valuation issue, and the IRS will take the highest valuation it can implant on you. Angels tend to be wealthy individuals. And usually people that are strategic in their field, experts in their field. So, you may have a former doctor and expert that came out of MedImmune or or iGen that will look to invest in startup biotech companies that in the space that they understand. There's a lot of value to that, and certainly if Steve Jobs or Bill Gates, Steve Jobs was still around and wanted to invest in one of your mobile apps, I think he would probably bring a lot of value to you. So it's not just the money, but it's smart money, because if you get the right angel that understands your industry and has been a pioneer or had a successful exit in your industry, they can also bring a lot of door opening capability, introduction capability, and bring a lot more to the table than the dollars themselves. So it can be strategic. Usually, if the valuation is set, there's usually a higher valuation given. The VCs are much more draconian. A lot of times angels, if they are going to set a valuation, will set a higher valuation. That can be dangerous if they're unsophisticated angels, and the value. An angel says, "Look, I'll give you $1 million for 10% of the stock." Well, that's saying a $9 million pre-money valuation and a $10 million post. If you're early stage, you may get that. It may sound great, but when the VC comes along and says, "We'll give you another $2 million, but we want 40% of the company," if this is Uncle Joe that gave you the money, you have to dampen his expectations that he may have a major down round when the next financing comes in, which leads us to the discussion of okay, next on the slides about convertible loans. So most angels, more and more lately, some angels are going ahead and taking Series A stock, preferred stock, and cutting a deal and valuing the company. But most of them do not like setting the value for the first money in the door. If you got your startup, you've done your proofs of concept, you build a beta, you've shown it to an industry expert. He says, "Wow, this is really cool. I'd like to. I'll give you 500,000, or I'll give 250, and Sanjay will give 250, and Yermo will give 250. That's 750 for you to get out there, hire your first sales and marketing guys, further develop the technology, build the platform to get it out there. We get the betas put out in a few major companies to try it, and then we get our first customers, and we're off and running. A lot of times they don't want to provide the value because look, when it comes to public comparables, public companies can often go on the market and compare each other. There's lots of data because of the SEC filing. There's all kinds of pro formas, financial information, and there's all kinds of balance reports and risk analysis and 8Ks, 10Ks, 10Qs all filed. So there's a lot of public disclosure. Private companies, there's not that much money, there's not that much information out there, particularly really startup companies. I mean, Yermo, I don't think there's a lot of people out in the United States who understand everything about your business, and there's a reason you haven't published it. Right. So how if you're going to compare yourself to Optime Software, or you're going to compare yourself to Yermo's company, or Pure Bang or something like that, you're going to have very, very limited. You may be able to go to their website, but you're not going to gather a lot of intelligence in terms of valuation, knowing how much revenue are they making, what are their expenses, what's their profit margin or EBITDA. So what happens is a lot of times the angels like to do convertible note financings, and they'll give you a loan. First of all, for the VC and for the angel, it puts them in a preference to you and any other shareholders. They're a creditor. Creditors come first. If you liquidate or go into bankruptcy, they get paid first. Every dollar liquidation, they get paid first. Then the equity holders. So they're ahead. What they'll generally do is say, instead of 8% dividends, I get 8% interest. So they'll charge an interest rate equivalent to what they would get if they had the stock. And then on top of that, they set it up so that when a qualified, they'll define in the agreement a qualified financing. So they'll say if there's a qualified financing, which may be defined, for example, $3 million or more within the next 18 months, then we will convert at whatever the VC comes in and negotiates the deal, whatever price per share that VC negotiates, we'll convert our notes into Series A stock along with the VC, and we'll tag along in the deal and be a co-investor. But we get a 20%, 10%, 20%, usually it's 20% discount. So you get a little bit of, for being the first money in before the Series A investor shows up, and to help give some money so that you can attract the VC and says, oh, I see you got some money and I see you're on your way, you've built out your technology. I get a 20% kicker, so I get the stock that the VC's paying $1 share for, I'm getting it for 80 cents. But oftentimes we then also, if I'm representing the angel, we'll negotiate a default valuation. We'll say after 18 months, at the election of the angel, I either call the note and say, all right, give me my $500,000 back and with interest, all the accrued and unpaid interest, or I will convert at a valuation of $2 million pre-money. So, or $1 million pre-money. If I gave you 500, then I own a third of the company. So you'll put in a default mechanism, if there, in the event that there is no qualified financing. Next. Venture capital. Okay, here's the real deal. This is the big boys that come in. You have your NEAs, your Carlyles, your Valhallas, your Frontier Capitals, Core Capital, Novak Biddle, the list goes on and on, just in this area. This is professional money. These are usually highfalutin MBAs out of Wharton and Harvard Business School and Darden, who are paid. They take a salary management fee to run the money for pension funds, CalPERS, whatever, and individuals who put money in. So every venture capital fund has a set of limited partners that and put the money up. And then the VCs that you meet with when you're talking to VCs like Core Capital, they manage the money, they take their fee, and then they have what's called a carried interest, a 20% carried interest. So when a company exits, if there's $100 million of profit made on investing and then selling the company, they take that $100 million, they take $20 million, and $80 million goes out to the limited investors.